Hi, I'm Charlie Jamieson, Chief Investment Officer of Jamieson Coote Bonds, and this is a review of markets in July 2022. To open the year, asset markets have actually performed pretty well, coming off very severe valuations in the June period. The bond market from its low valuation point has rallied back nearly 6.75%. So there was a lot of discussion at that time about there's some of the absurdity really in the valuations that were being expressed in the markets. The momentum kind of algorithm funds that were driving those final stop outs of positioning. But with a change in narrative from looking and feeling like inflation is the major issue of the day, clearly it's still a very important issue. Now this negative growth element, which is clearly our expectations for the second half of this year and into 2023, has started to capture the attention of markets. Bonds have started to rally in expectation of some crescendo in policy towards the end of this year. And clearly equity markets have really enjoyed that, with bonds taking off first and then equities and corporate credit markets following along in a recovery rally through that period. The Federal Reserve, which really leads central bankers in terms of policy evolution, have made some suggestion that they will be more data dependent. They don't meet again until September, and that's the back end of September. And this has given rise to some kind of commentary in markets about that pivot that we've talked about for the last few months, that really important moment where policy turns and becomes very supportive for investors, and there are great tailwinds. Clearly this year we're going straight into headwinds of the removal and moving to restrictive policy. Should that policy pivot to a neutral setting or an accommodative setting, obviously that's the best time to get invested. We think it's a little bit early to be talking about the pivot. There are certainly more rate hikes to come. Inflation is still going to be problematic into the back part of this year. So there's a few things in that pivot that we thought we might mention just to think through in order to find that moment. Obviously, we're enjoying what could be described as a bear market rally at the moment. As the economies weaken, which they certainly will, as we're slamming on the brakes of monetary policy, we potentially have quite a recession to get through ahead. There is talk of soft or hard in terms of recessions. We think soft is probably unlikely, and it will bite with some lag effect. The pace at which we've been hiking interest rates is simply unheralded. I mean, to do it on such large volumes of debt, on such interest rate sensitivity, there is no observable change immediately once these interest rates are lifted. It does take a lag of time to really percolate through to the economy, and we do expect that the incoming data will be substantially softer as a result. So what is going on with this pivot and this enjoyment of this relief rally in many markets? Well, clearly, if we think about the pivot, I'm going to explain them to you as positioning, inflation, Vladimir Putin for the V, oil, and the Treasury market, PIVOT. Positioning has been obviously very low, and so the possibility for some kind of market squeeze has definitely been there. In our own markets, there have been folks that have been very underweight fixed income in expectation of further momentum moves to higher yields, and have been squeezed very substantially now as rates have rallied considerably. And that is causing some investors to turn around and stop out or stop back into positions. So positioning is always something that's important to think about, and the participation of different types of investors. There are, of course, those funds that live and breathe to cause maximum pain and chase down those kind of seek and destroy elements in the market and really take advantage of big positioning clusters in particular assets where they believe there is vulnerability, and that could be occurring at the moment. Inflation is probably peaking, but it has not got a clean pathway to getting back towards mandate. We know that things like goods inflation is definitely moderated substantially. Energy inflation looks to be moderating at the moment. Food prices are now lower than where they were in pre-Ukraine Russia, as are most base metals in the commodities indexes. Services inflation is still a bit sticky. So inflation is going to start to moderate, but it needs to moderate very quickly to give central bankers room to go to that neutral setting, which investors are generally looking for. We don't think it's going to happen fast enough, and there will be, albeit slower and smaller rate hikes. We will continue to hike rates into the latter part of 2022 to really crush that inflation expectation. And this is where Vladimir comes into it. He is a very credible bad guy. He has been in power for a long, long time on the global stage, right back to Clinton days. We have, Sleepy Joe in the United States. We've got, a power vacuum in the UK, German Chancellor who's been in the job for 5 minutes, and Putin has been there and seen them all off and is still there. He kind of has everybody absolutely where he wants them at this stage in terms of European energy is severely undersupplied. Prices there have gone up 6 or 7-fold already for utilities. Just think about that. Your own power bills going up 6 times. It would be incredibly difficult economically. These pipeline flows of gas running into Europe are running at very low levels. Storage is very low. There is the obvious moment to go to checkmate in terms of his own negotiating strategy, and that is to shut the power off in October when it gets cold. That will coincide with Biden having to rebuild the Strategic Petroleum Reserve. He has drawn 180 million barrels or more out of 740 million barrels that's only been accessed in times of material crisis. Well, Biden used it in a political crisis to try and bring the price of gasoline back down. Now that has worked, but he is regulated to restore that capacity, and that starts in September. So this will coincide right with when the obvious moment potentially is for Putin to shut off energy and cause real chaos in Europe and probably send a European recession globally at a kind of turbocharged rate. Clearly, the big swing factor in this is primarily the oil and energy markets. Now, natural gas in Europe is probably the only thing that's higher pre-Russia-Ukraine war. We've got oil lower at the moment. There is obviously a weakening demand profile as the economy's slow, but we've still got China to come back online from lockdown. So I think oil, it's a very difficult thing to forecast at the best of times. There are so many moving parts, and the decisions of these key geopolitical folks, can have such a big swing factor in the way that it does set. But we know that there's been a vast investment in these energies. There's been a big movement towards ESG, which cannot fit the entire void at this time. We know that the capex cycle has been very low. Those that went into to shale or fracking and these types of things, they lost a lot of money in the last cycle. So that capital is not easy to find again, and the time it takes to restore that capacity is a really long run time frame. So whilst many other things in this inflationary story can be solved and are being solved by capitalism, energy will be solved, but it's just going to take more time. And that can be very problematic if it doesn't allow inflation to come down quickly towards the end of the year when we're looking for relief from central bankers and monetary policy. Treasuries being the final thing in the pivot that we're looking for. We have this intense inversion in the US Treasury curve at the moment. We're at 2-year, 10-year bond rates. The differential is now at negative 37 basis points as of today's filming. This has been a perfect indicator for predicting recessions, and it is severely inverted now. It probably continues to go on to further inversions because the long end of the Treasury curve is expecting that credible central bankers will deal with inflation expectations. They will get inflation to trend back down. And in doing so, they are going to have to drive short-dated funding rates further up and take money out of yours and my pocket. If you've borrowed money and you've got to make repayments, those repayments are going up. And that means discretionary spending in the economy is going down, bar nothing. That's just it. And so we will expect that, clearly the economies will continue to tighten, particularly as the lag effect of these monetary policy movements come to market. Don't forget that we've done 175 basis points in Australia now since the May meeting. That means that people are really only making their second mortgage payments at higher rates. But it is not the price of that payment, it is the time as well that payment exists. If mortgage rates go to 6% for one payment, it's an uncomfortable month. If they stay there for 24 months, it's a horrible outcome for many people that have borrowed money. So if we hit the brakes hard and then can come back down with regard to monetary policy, that's our best case for a soft landing. If we hit the brakes hard and need to stay in that state for some time, that's when the default cycle starts. It's that time which generates delinquency. And so that's a really critical thing. And we've got to get these inflation rates down so that some accommodation can be returned to offer relief to those that will require it under tighter economic settings. Our premise is absolutely that we are going to have a very volatile second half of the year, as we saw in the first half of the year. We do expect that bonds will find more negative correlated moments than they have done previously. Bonds were absolutely the problem at the start of the year. A lot of folks were obviously pretty upset with the performance of the bond market. But as we said all along, where bonds go, other things will be taken. And we saw that in the second quarter, where clearly credit markets and equity markets really underperformed, and they underperformed very quickly. So it really is important that we follow these bond markets to give us guidance as to where these things might go. At the moment, as we've said, that relief rally that we've seen in bonds on growth concerns is helping to stimulate other markets like credit and equities. But we worry that if the recessionary moment does come, and we've got to remember that in equity land, dividends are done on a best endeavours basis. We'll try as hard as we can to pay that dividend. Bonds are a little different in that regard. They are legally contractual coupons that will be paid. If the government is offering up 3.5% or 4% coupons that are guaranteed, that is tremendously attractive, and it's worth your consideration within the context of your own portfolio. And clearly those things can perform very well if we are to have that horrible moment of a deeper recession where we worry about liquidity and we worry about asset quality and those types of things. So all in all, we think bonds are normalising. They had obviously moved far too far in expectation of RBA cash rates up to 4.5% within 12 months. I mean, clearly the economy would slow to a halt at those levels. It's not impossible, but it's very improbable. There has been a normalisation in that thinking to some degree, but the RBA are telling us they've got to get to neutral. So we do expect that they will push on towards 2.5%. It is our expectation they should hike another 40 basis points and then 25 to pause, as I think we'll see from other central banks, just to hold, to rationalise what has occurred, have that benefit of the time data coming in to see what those lag effects are looking like in the economy, to make sure that they haven't severely over-tightened. They can always move again later on, but if they go too far, then they're going to have to cut quickly as well to try and re-stimulate things. Thank you.